Okay, it's 11 o'clock. We should get going. So our guest this week is Richard Hulf from HydrogenOne Capital Growth, and he'll be updating us with what's going on in the hydrogen sector. But before we get there, a few bits of news to run through, as usual. So firstly, Menhaden, and then BlackRock American Income. Both these news came out this morning, and Renewables Infrastructure Group. So we'll start with Menhaden. That is its track record, more or less since launch, I think. And actually, it doesn't look too bad, but you can see the extent of the discount there. The discount got very, very wide until they said, we're going to give up and do something else. Even now, the discount is about 11%, and there is a good reason for that, as we'll explain. So this is the 10 largest holdings. It's a very concentrated portfolio. If you remember, it was all about energy efficiency. That was the theory. I think the messaging was a bit confused around that. A lot of people didn't really understand it was in the environmental sector, and it held things like Alphabet and Airbus and stuff. But everything had a reason to be there in their eyes, so that was fine. Some of it is unquoted. The Avantus Clean Energy is a fund that's a limited partnership fund, and the TCI Real Estate Partners 4 is the same thing, so that's another kind of limited partnership type fund. So it's about 20% of its assets are in unquoted. It's liquidating, so there's a meeting to approve that on the 25th of March, and you're not going to be able to deal in the shares after the 24th. So please do bear that in mind if you're a holder. There is a dividend that's already gone XD that we paid on the 24th of March, 2.1p. And the NAV after that ex-dividend is 175.7p, or 143.4 million pounds. So once the liquidator is appointed, and it needs 75% approval to get that done, I think that'll probably happen. The liquidator will take until the 26th of May before it pays anything out. I think that's actually quite a long time. I think they could have got their act together a bit quicker than this. But when they do that, it'll be about 127p, they reckon. So there'll be another 36.8p, which should be unquoted, so they're not revalued. And they're also keeping some money back because at the moment they have commitments to those funds to invest another 13.6 million pounds. So they need to keep their money on hand until they can get out of that commitment. There's no timetable around realizing these. They're talking to the general partners, the GPs, about facilitating some kind of transaction. It won't necessarily be at NAV. Quite often secondaries change hand in the market at a discount. So that's to bear in mind. So that bring the NAV down a bit. And then the cost of liquidation are about £900,000, which is quite chunky, but that includes the payoff for the manager that's getting fired and the AIFM. So I just think with Menhaden, you have to think about how fast do I want my money? Do I want the certainty? And I'd look hard at whether you want to just sell the shares in the market before it stops dealing. But that's me. BlackRock American Income. It's not very big. It's probably too small, really. 143 million pounds. It's on about a 6.8 discount. It has a yield, obviously. If you remember, it used to be Sustainable American Income. They dropped sustainable because of the EU rules around, well, the FCA rules really about promoting things as sustainable. They haven't got demand for the product in its current form, so they are going to rejig the whole approach. This is coming from the board, and they're adopting this investment approach called systematic active equity, which, as far as I can work out, is some kind of quantitative thing with a sort of active overlay to it, or an active tilt. So the computer chucks out some suggested buys, and then a human looks at it and says, that's a good idea, that's not a good idea, and then deals accordingly. and they sort of try out the AI things. Obviously, that's a big thing now. But these kind of predictive models about quant models have been around for a very long time, and they've been investing in them for a very long time. It's still sticking with the value approach. So that's the screening a bunch of stocks for value is that it's a relatively easy thing to do. You just do it by yield or PE, whatever. So they're going to stick with that index as a benchmark. They've got some money in Canada now, but they're going to be probably going to be 100% in the US going forward. They will use some gearing, so that's one reason to keep it as a closed-end fund. They won't use options anymore because they had permission to use options to help generate some income, and they're not going to do that going forward. So that will come out of the investment approach. The ESG part of it, although BlackRock may have some ESG screens in there, is not going to be a big part of the thing at all. So that sustainable thing that was taken out of the name and now has now been taken out of the investment approach. It will have quite a punchy dividend, about 6% yield, which is way higher than you can normally get in the American market. But obviously some of that is going to come from capital in the kind of way that we've seen a lot of other funds do. And 6% is fairly chunky, I think. The systematic equity team has been going for a long time, 90 people working in it, 25 billion. I think actually probably should be dollars rather than pounds in large cap strategies. Based in San Francisco, it's obviously chucking money at and all the computing power to do all this. BlackRock is, if you're going to do this sort of thing, BlackRock's probably not a bad manager to do it. There are two named managers. You've got there Travis and Musso, both with a long track record of doing this stuff. What I haven't seen yet is any sign of performance data. I think that might be in the final circular when that comes out. You might look at that to see what it looks like. Given that the computer's doing most of the work, it is entirely reasonable that the fee gets chopped, and they've more or less cut it in half from 0.7 down to 0.35 and 0.3. It's missed opportunity not to base that on a lower of market cap and NAV, which is, as we said, is probably best practice, and most people seem to be moving to something along those lines. But nevertheless, it is a move in the right direction, and that will probably be welcomed by most investors. But for those that aren't convinced by this, there is going to be a 20% tender and a 2% discount now. You're going to have to elect whether you want to do that or not by 17th of April, and then you'll get the cash around the end of April. And there'll be another much bigger one in 2028 that's triggered by underperformance. So basically, the target is to beat the benchmark by at least 0.5% per annum per year. And then saying, if you don't manage to do that over a 3-year period, and 30th of April 2028, we're going to give you a chance to get all your money back at a 2% discount to full asset value. Now, I think, and there is obviously that other tender there, that if the fund shrinks, I think it's quite likely that if it isn't working, then the whole thing will be wound up before that anyway. But we'll see how we go. In which case, obviously, you won't have the 2% to FAV hit. You'll probably get out asset value. But so it's a last throw of the dice, I think, for this. But it could work. I'm not saying it won't. I think, you know, it's jury's out a bit. But if it was me, I'd probably hang on and see how it goes. But I probably would like to see what those performance numbers were for the existing strategy. In terms of the costs, the BlackRock are going to cover the cost of the proposal, so they won't cover the cost of the tender offer. So that obviously brings the NAV down as far as that goes. They're going to waive their fees for the first 6 months, which is obviously very welcome. Their shareholders are going to get to vote on this at the AGM. But if shareholders really don't like the idea and don't want to keep the fund, there is a continuation vote as well at the AGM before this all happens. I don't think it's going to lose continuation vote. I think it probably will get approved. So it's likely to happen. That's that one. Trig now. Now we've seen a lot of these graphs recently. NAV is sliding. I mean, there's no getting away from that. But the share price reaction has just been way overdone. and the discount is now looking ridiculous, getting for 36%, and obviously that means the yield is pushed up, and that's over 10%. That just seems daft to me, that this is ridiculously undervalued, and we'll come to what the board thinks about that in a second. So these results that have come out here, it's a familiar kind of pattern. The NAV's come down again. The dividend target is being edged up, but not by much. It's interesting, disappointing really, the dividend cover was only 1.0 times last year, but they have had a big drop in income, as you can see there. They've been making disposals, and actually the sales that they've been making have been at a premium to NAV, and that is good news because that suggests that the NAV's about right. They've got another £300 million worth of disposals in the pipeline, and they've been using the money mainly to cut gearing, but a smidgen of it has gone into buybacks, £21 million. They've upped the target for buybacks to 150, which won't necessarily all be done this year, but that is now the target, which is obviously encouraging given where the discount is. The reasons why the NAV fell, the 10-year bond yields have been stubbornly high, and that is pushing up discount rates, so that took off something. Generation was not as good as they wanted it to be. Inflation was not as high as they expected. They've got a lot of assets overseas, and sterling strengthened a bit relative to some currencies. They had to rethink the amount of energy that they're capable of generating on an average basis, and we've talked about this before about lower than forecast wind speeds, for example. So that's had an effect. Battery revenues, we know, have been a bit disappointing. They haven't an awful lot of batteries yet, but they are building more of those things. And there's been issues around the grid infrastructure. So yeah, I mean, all of these things are just part of the course story. They've been affecting everybody. Big news though is that they've rejigged the fees, and this has caused a lot of confusion with some people. Well, not confusion, consternation maybe, I don't know the right word to this, but basically it's become a talking point. So firstly, they're cutting the base of the fee to the average of NAV and market cap, which we've seen elsewhere, and as I said before, that's great unless it goes back to a premium, but I think that would be a lovely problem to have. And then obviously some of the board will do something about that. There's a new transaction fee, and I think this has been a quid pro quo. So the board said to the manager, look, we're going to cut the fee because of the market cap so wide, so small, so it's lower, sorry, than the NAV. The discount's too wide. So as a quid pro quo for that, the manager can now earn transaction fees on the sales that it's got planned, and also new debt financings. And then the fees that it owns on those, which is about 0.5% of the transaction value, will be added back into the management fee until you get back to where it would have been had they been charging the fee on NAV. So some analysts have been a bit dubious about whether that's justified or not. I think I'm not decided yet. The interesting thing though, and this comes back to what we were saying about the really wide discount, that they've introduced this takeover fee, which I'm really generally not a fan of. I'm very happy for managers to get paid out if they're going to get sacked. That's totally fine. But this kind of is like an incentive if they get taken over, which maybe means that they'll be going out looking to get taken over. I really don't know. But the way that fee works is 3% of the excess over NAV plus 3% of the excess over market cap, all capped at just under 5% of the lower NAV and market cap. They must have been thinking about this for a while. It's not a response to the launch of Achilles that we talked about before. I don't think it could even be in response to the takeover of BBGI, because we didn't know about that until relatively recently. So clearly, Trig's board have been thinking somebody might come along and buy us given where the discount is. and the manager's been saying, well, if that happens, we want to get paid out. So there we go. I'm not massively in favour of it, but it's there. And obviously, if it did get bid for a price premium to NAV, that would be amazing. So that's enough from me. Let's now talk to Richard.
Morning, James.
Thank you very much for doing this again. We're quite keen to hear what's going on in the hydrogen sector. So you've got some slides. And
yeah,
as usual,
pleasure. Thanks.
I will
Thanks very much.
hand over to you and let you talk us through them.
So disclaimer. The energy transition theme seems to be at the forefront today. So let's try and talk about that a little bit. I'd like to talk about that in a broader macro context, and then perhaps touch on parts of the fund, and we take Q&A and all of that at the end. So the emphasis here is on why hydrogen, what's driving the hydrogen economy. The first point is the energy transition. The world is shifting to cleaner fuels. It's less of a mega trend, though, that people may have been talking about a few years ago. More of an evolving landscape of investable companies and projects that we're finding in the hydrogen sector, and we can go to that in more detail in a moment. It's also driven by air quality, consumer need for a green product being a better product, even though the cost may be higher for green hydrogen in parts of the value chain. Certain consumer companies are moving towards it. And the final point is energy security. Varies by country and region, but particularly in Europe, where we've been reliant upon Russian gas, it's been a big issue. But it may be worth digging into some of these points in a little bit more detail. What's going on with energy transition at the moment? There's definitely been a pullback. It's affecting some of the funds you've already been talking about. But in the real world, last year was a record year for renewables. 15% of global energy came from the renewable sector. Great. So what's going on? It was also a record year for oil and gas production. And so we're not really seeing an energy transition here. We're seeing energy addition from what's coming from the renewable sector. But this transition, unlike previous transitions of wood to coal and from coal to oil and gas, is costing a lot more, and that's the issue. But the increasing cost varies very much by location. It's not a linear trend. It's a sort of a multi-dimensional trend in different parts of the world, in different parts of the energy chain. We're seeing differing results. The US, of course, doesn't have an energy security issue, so Trump can say, well, whatever he wants. But in Europe, we definitely do. So this is where hydrogen becomes a very interesting fuel, because it's part of the electrification, which is driving this sort of energy transition, and it's quite flexible. And if we go on to the next slide, we can talk a little bit more about what's driving energy demand right now. One of the key ways that you make hydrogen is by splitting water, and you split water with electrolysis. Now, we're not betting on a revolution here with the hydrogen fund, but it's about carefully selecting investments in parts of the world, in Europe and in the Middle East, for example, where demand for electrolyzers is going up, and this is a straightforward trend that we're taking advantage of, and you can see that in the graph from Goldman Sachs on the right hand side there. This is one of the key value drivers in the companies we invest into in the energy fund. So next slide, please, James. So let's get into a bit more detail about where is hydrogen playing a role. And so you can see lots of applications, lots of cases with no obvious alternatives if we're going to get to net zero. So it's the industrial gases. If you're going to decarbonize industrial gases, there are very few alternatives in making plastics, fertilizers, ammonia, steel, cement. You have to use hydrogen, and so there aren't any alternatives. That's a very key part of what we're doing. So that's why we're investing into hydrogen now. Heavy transport, ships, trains, coaches, buses, trucks. To decarbonize that, you have to use hydrogen. Batteries are a much better solution in light transport, as you can see further down. There is not really competition there, but it has to be used for that. And in grid balancing and in conversion of grid power, the UK hydrogen policy is based upon converting the gas-fired power plants to hydrogen power. That's a key role. There is some applications in flight where we're seeing synthetic aviation fuel being used. That also relies upon hydrogen as well. So there are very targeted places that you have to look, and that's what we're specialising in with the Hydrogen Fund. Next slide, please, James. So how does the hydrogen value chain work, and why is that relevant to us now? Renewable hydrogen comes from splitting water, biomethane, a native white hydrogen down below can actually come out of the ground. So these are the sources of hydrogen on the left-hand side. The great thing about hydrogen is it's not so much burning hydrogen, it's using hydrogen as a carrier for electricity. And that's why it's very relevant and it's playing a role in energy transition now. And where is hydrogen then being used? It's used as a gas. It's used in electricity, because you can put hydrogen into a fuel cell, which produces electricity on the other side. That's being used increasingly in mobility. And then you've got liquids where hydrogen is being used to make ammonia, methanol, synthetic aviation fuel. So it's a very key part of the value chain right now. And if you go on to the next slide, James, we can see where this green hydrogen is coming from. A lot of people say, well, great, show me a hydrogen project. There's 1.2 gigawatts of clean hydrogen in production today. That was up 50% on the previous year. So we're seeing a lot of hydrogen projects coming on stream around the world, and nearly 40 times as much of that in development around the world in different locations. We did a recent bit of work looking at, well, if hydrogen doesn't work, what about the synthetic e-fuels, to make ammonia and others? There are much fewer of those projects coming on stream around the world. It's a very solid basis for strategy going forward by looking at green hydrogen projects. On the next slide, James, we've got some. Well, show me where that's going on. Some examples here in Sweden, the US, and Germany. That's 9 gigawatts of green hydrogen coming on in real locations. That's going to be 1.2 million tons additional hydrogen per year coming on, and an 18 billion capital cost. So this is serious money with serious backers going on a large scale, and we're sort of tapping into that. A little bit about the fund on the next slide, please, James. So NAV per share, this is just taken out of our last quarter results. There's clearly a terrible discount to NAV. NAV 90p, share price around the 20s, and we've got to do something about that. Clearly, we've got to demonstrate the value in the sector. The NAV was trimmed recently. We had a surprise from Foresight Energy on one of our projects. They suddenly just pulled out in Germany. But at the same time, the NAV was underpinned and demonstrated by another sale of an asset in Norway, the Gen 2 asset that was sold at NAV. So we're seeing that, but we were overshadowed by that one that was sort of one-off event. And we're attracting a lot of funding from other strategic investors into our investments in other parts of the portfolio. But to address this discrepancy between, we've got to do something about the discount. So we, the advisor, have been we're in the middle of being taken over by Cordiant Capital, a much larger platform, which is giving us much better access to capital to work with the existing assets in the fund. So you'll see more of that going forward. Just a quick reminder of what's in the fund on the next slide, James, please. Where do we invest? It's all private assets, dominate 99% in private assets, with a remainder in cash. We sold all of the listed assets over 2024. All invested into these companies: Sunfire, HiRock, Elcogen, revenue generating portfolio. 41% in the UK, the rest in the EU, but most of the UK companies selling into the EU. If we go on to the next slide, we can see the sort of investors that are with us investing into these companies. Notable strategics, specialist private equity funds there. And we're showing sort of related activity of, I noticed one of the investments that one of the previous funds you mentioned had made was into Safran. Safran are a co-investor into Cranfield Aerospace with us. And you can see one of their projects on the right hand side there. So the point is to sort of demonstrate that these are real projects, real companies, and real assets that the hydrogen sector is working through. Next slide, please, James. So what about revenue growth within the portfolio? On the left, you can see how revenue has grown since we invested. The early investments into Bramble and Sunfire have grown the most, and other investments in HiRock and Strom, they're catching up now. The revenues generated by all the companies in the portfolio aggregate on the right hand side there on a 100% basis. Slightly moderated in the second quarter, but generated 85 million in revenues over the last 12 months by Q2 24, up 11% from the previous period in 23. Let's talk a bit about Cordiant on the next slide, please, James. Cordiant Capital is agreed to purchase HydrogenOne Capital LLP, the advisor. We announced that just before Christmas. We're just moving towards the completion of that transaction now. Cordiant is a global specialist infrastructure and real asset manager, but $4 billion US under management worldwide. The transition's expected to result in an acceleration of our market access and capabilities compared to the standalone strategy. We need like-minded investors that can see the long-term potential of hydrogen. One potential scenario may be for HGen, the existing listed fund, to sell some of its assets to a new fund that could be set up on the Cordiant platform. It's the interplay of those two. It's attracting capital from the private market as it migrates away from the listed market. That the Cordiant company is really going to help us. So we expect to complete that transaction quite soon, and we announced that back end of last year. And so on to sort of a conclusion. The point is, we're trying to make the hydrogen sector is real and it's growing now. We're very well positioned to look at it's not a wholesale mega trend with hydrogen. I mean, if you think about the new, let's make a point about this energy transition. A lot of the energy transition goals were derived during the COVID period, where energy demand was very low at that point, and so going forward, it's proving to be very difficult. We're moving back to a more of an oil and gas based economy, but even the integrated oil companies, BP announced a movement back to oil and gas, but it hasn't changed anything on its hydrogen. It's still going ahead with hydrogen. Number of companies in the US signed a letter back to Trump. A lot of oil and gas companies saying don't cancel the Inflation Reduction Act, because people want to carry on investing in hydrogen because it's here and now transition technology. So just rounding off, we think the Cordiant deal is going to make a big difference for us, and we expect to demonstrate the real asset value in the portfolio by starting to transact on that basis going forward. So that's the conclusion, James. Thanks very much for that opportunity. Very much like to take any questions about the sector, about the energy transition, and about the fund itself.
There we go. Sorry for the delay. They have to put me back on again. So thank you very much, Richard. That's really quite useful. Can I sort of go back to the beginning, if you don't mind?
Yes.
So actually, no, let's pause on this one. So you've got a focus that is largely on Europe and UK, but there's a few questions about Trump and the sort of IRA and just the general kind of drill baby drill kind of attitude towards this thing. To what extent does Trump matter? There's lots of questions in one here. To what extent does Trump matter? To what extent are these things going to develop with or without government support? Maybe just take those two first.
Yeah, sure. Trump doesn't matter to our fund directly because all of our investments are not in the US. But as we grow, we do want to invest into North America and some of those projects. The sort of initial reaction was that, you know, drill baby drill, that surely that means the end of renewables and everything in the US. Sure, there will be fewer windmills and solar panels in the US, but he hasn't specifically yet deconstructed Biden's work on the Inflation Reduction Act, and there's been it was announced last week, I think, a letter from, I mean, one of the biggest proponents against renewables in the US was the American Petroleum Institute, API, but they actually signed the signature along with a lot of other oil and gas companies back to Trump to say, don't unwind the Inflation Reduction Act, because hydrogen is a very useful part of the electrification process in the US. A lot of data centers that simply can't get enough electricity from the grid, even if there's a grid connection, need hydrogen as a backup fuel, because you can store electricity with hydrogen. So it's a here and now technology which is very much needed, and so you're not going to see wholesale switch from hydrocarbons into hydrogen, but hydrogen was never meant to be that. It was always going to be a very here and now part of the transition going forward. So that's the case in the US. In Europe, it's quite a bit more to our advantage, and you'll notice, I scanned through it quickly. HiROC was one of our companies here, considered number 2 there. What HiROC do is they basically convert methane into carbon and hydrogen, and so it's very useful right now for a lot of companies that need to get hydrogen but need to get rid of methane. In Europe, policy is very important. You've got this thing called the Carbon Border Adjustment Mechanism, or CBAM, which basically means any steel or cement or any product that comes into Europe has to pass a very low carbon content adjustment. Therefore, it's no surprise that one of the biggest investors in HiROC, along with us, is Cemex, Mexican cement producer, because they want to produce cement in Europe and import cement into Europe. So to do that, they've got to reduce the carbon of how they make cement. You make cement using hydrogen, by the way, it's part of the reduction process. You also use it as power. And so policy is playing a much bigger role and affecting a lot of our companies directly here. Even if you produce your products, your steel and your cement inside Europe, you've also got the emissions trading system in Europe of ETS, which means you have to start using a low carbon energy use to make those basic products of fertilizer, steel, cement, and other things. And so, yes, I mean, I come from the oil and gas sector, so does JJ. My family, we always thought it was crazy that the world suddenly said, right, that's it, no more oil and gas, switch over to all alternatives. It's can be completely unrealistic to do that, and that's what we're seeing as sort of a readjustment now. But hydrogen is an excellent transition fuel because of the carrying properties and because of its role in electrification, as opposed to wind and solar as the basis, which I think have probably been less of a victim of the mental backlash to transition, but more a factor of borrowing and discount rates and interest rates on the way that their projects are funded. Sorry,
Yeah.
long answer.
No, that's good. That's good. But you just pick up one of those things you mentioned there. So, in terms of using hydrogen as a sort of means of energy storage, how did the maths add up? How does it compare to using, say, batteries? And how, I know all these things are subject to Moore's law type thing arrangements. How fast is that cost of using hydrogen as a means of storage coming down relative to the cost of using batteries?
Yeah, well, that's a good technical question. It's not a matter of batteries or hydrogen. Actually, you use both. What the way that these systems work is that the battery has got instantaneous current and voltage response, whereas hydrogen going through a fuel cell isn't quite like that. So it's not quite as instantaneous, although some technologies are working towards that. So whenever you get these backup power systems, you have a fuel cell with hydrogen sitting behind it, supplying electricity into a battery. So the whole thing sort of works together. But you've got almost an endless source of recharging the battery from the hydrogen, if you see what I mean. So that's how these systems work. Batteries don't work on their own. Hydrogen doesn't work on its own, but they're always combined. So in the data centers in the US, where you've got a grid connection, but the rate at which we're using artificial intelligence and electrification is well known, and it's going off the scale globally. Our grid just cannot cope with the higher power sources that are needed. And so that's why you're seeing companies like Microsoft talking to hydrogen and battery companies in the US to install those facilities to give them enough electricity. So hydrogen has got put into this place of, well, it's either that or that. Hydrogen is never really competing. Was never competing with these things, but it works in conjunction with them. And it's quite complicated, but that's why we're a specialist fund, because we get into all the locations and contact all the companies to know where the best returns are coming from. Because we're ex-oil and gas people, we're used to IRRs of 20 to 100%, and so that's the reality of hydrogen. That you can get those sort of returns if you're very targeted in the way that you invest.
Again, thinking bigger picture. So, to my mind, this was always going to have a bit of a J curve. This fund. I didn't expect HH2E to be the first thing to go not work, but that's by the by.
Neither did we. Yeah, that came like night before. Yeah.
But how long holding period do you think these things need before they make you serious money? I mean, would you be worried about selling things too early just because you need to make a win?
Well, we said before, and it's still the same, the holding period 3 to 5 years for these investments. It's taken longer at the moment because there's been a pullback, and some companies that are working in these spaces, like everybody, are having liquidity problems. So 3 to 5 might be 4 to 6 if you add in that initial amount. So what becomes important in the short term is keeping the lights on, basically, with the investment vehicle to have enough cash to keep on running. So that's why we're working with Cordiant to start trying to generate that cash for Fund 1. The worst that can happen is the funds run out of money and they have to close up. The best of the worst is that you get diluted on some of the investments that you've got, because if you look at the other investors with us, it's Copenhagen Investment fund, billions at AUM. It's Centrica, it's Jeff Bezos. These are deep pockets. There's no, so they will carry on funding, and we may get diluted. But the returns generated from this fund are not sort of incremental revenue growth. It's sudden takeover of these businesses, or IPOs are out the window at the moment, of course, but that will return. It's about keeping the vehicle going to the point where the market does start to pick up, and all of these hydrogen hubs and smaller projects start to join together. Infrastructure starts to grow, and before you know it, the internet is everywhere. Nobody ever thought that was going to work, but eventually you missed it when it did start to work. So that's why you have to have some investment into hydrogen, so that when these things start to scale up, with that horrible word, the J curve, as you say, absolutely be upfront though, it has slowed down, but it's not failed. It's not going away. It's just that it's taking long to get there, because it's very, very, very complex.
And then when you do make a disposal, and I'm not asking you to put a time frame on that, but when you do make a disposal, what will you do given where the discount is?
Disposal of an asset in the portfolio. Well, I mean, the share price has no bearing on the transactions that go on within the fund. So when Sunfire decides to IPO, which is, everybody can see current markets are not going to support that. But there may be some surprises with companies like Cranfield or Bramble, which are less sort of revenue growth based, more sort of ideas based. As you see Toyota start to supply fuel cells to BMW, who are now about to put an X5 hydrogen version on the road, suddenly these things light up and become interesting, and there could be a takeover of one of those businesses. But this is all going to be, these are going to be done. What we want to see is multiples of net asset value are the offers that we get, and in our all of our valuations for the portfolio are based on detailed discounted cash flow calculations and other metrics that compare to EV to sales ratios of companies in the market. So the share price hopefully reacts to that and sees that actually these companies are worth NAV plus. But you're right, James. That's what we've got to demonstrate. We did it in a small way with a sale last year, but unfortunately, it was overshadowed by the surprise HiRock announcement. HH2 announcement that we had to make. But as we go into this year, we will look to the rest of the portfolio to see where we may be able to. There may be secondaries that the fund can do that will involve our work with Cordiant on the new platform in having access to limited partner money that takes a long-term view, that wants to seed bigger portfolios with proven hydrogen assets from our existing portfolio. This is sort of the proof case for a lot of investors that want to put money into a larger platform that could be seeded with part or some of the things from this portfolio. Just saying that's how something could work.
So to answer the question here, so the reason why the NAV went down second half of last year was HH2E. Those projects were quite far advanced. What's happened to the company now? Went into administration, but is somebody actually developing those projects going forward? Have they been picked up by anybody?
There are. I mean, I have to be careful about confidentialities here, but the process is being run by EY in Germany, and there are current bidders, some very grown-up bids, to try to take the assets out of that portfolio. Just so people know, you're absolutely right. It's a world-class project. The HH2E locations in Germany. had prime access to electricity. I mean, getting a grid connection is like gold dust globally at the moment. So there was grid connection. You could even use the site for a battery and hydrogen storage location from all the renewable coming in on the German grid to solve that intermittency. So that, yes, it was a world-class location where in Germany, this is another example of an economy very much driven by energy security, very much driven by clean air, and policies to back up and support that, to encourage investment in these projects that take green electricity, split it and make hydrogen. Hydrogen goes back into the industrial Rhineland, where all of those refineries that are use hydrogen for desulfurization, for ammonia, and other plastics production, need to have green hydrogen because of the way the German policy towards these things work. So, yeah, it was a great project. I think it was more a function of what was going, and it was an unusual investment for us because Foresight were the only other investor. I mean, what we tried to demonstrate with the other companies is that there's a portfolio of investors there. If somebody says we don't like it doesn't matter, because other investors will step in and take their position. But we don't know why Foresight decided not to proceed. It didn't make sense. And for a lot of investors in us who also held Foresight, they were asking the same question. You'd have to ask them. It still is a mystery why that happened. I think there was a complication of there were multiple parts of Foresight that were making decisions, and hydrogen can be quite an emotional subject for people at the moment, because when you don't understand it, you just say I don't want it, and so there are individuals who sit in positions of power and control that just say I don't want it, I don't believe it, but the facts just defy that completely.
Fair enough. There's a question here about the clean industrial deal for Belgium, Germany, and Netherlands. Do you know anything about that?
I don't off the top of my head. What I do know is Europe has got a very strong energy transition framework. The European Innovation Fund sits behind that, so billions of euros in funding, unlike millions in the UK. We're a little bit behind, hence our exposure to Europe, have been made available for companies to invest into the hydrogen sector. And as I mentioned, we've got the emissions trading system, but there are lots of sub projects that involve different parts of Europe. But no, not off the top of my head.
But where you do have government support, does it come in the form of tax breaks for developing stuff, or tax breaks for producing hydrogen, or what sort of
all of the above? I mean, in Germany there are billions of euros of just pure cash available to subsidize the capex stage of your project that you're building. There are and then contracts for differences. The UK was pretty good at CFDs in launching the wind and solar sectors in the UK. This is where, I mean, the big issue about getting any project off the ground is you're not going to put billions into building it unless you know someone's going to buy what you're producing. And so you need to secure the offtake contracts before you get there. And the governments can play a big role in providing that security to encourage people to enter into long-term contracts. So that's an important part of the European renewable landscape. Capitals go into projects directly, and indeed policy. The other thing that Europe's very good at, if you think about we mentioned the Netherlands, the great trading ports of the Hague and Amsterdam, they would just say, as they did a few years ago, no heavy sulfur fuel oil powered ships allowed. You can't come in, and there are new targets in place in those ports for carbon and emission standards. So that is forcing the global shipping industry to move. So it's not always about providing cash. Sometimes it's about incentives. I mean, there are standards of emission standards around HGVs in Europe, which is very much accelerating the move towards hydrogen with trucks, because you cannot run an HGV on a battery. It doesn't have the range, doesn't have the power. But hydrogen is the solution there. So there are several schemes that are sitting behind that involve firms like Mercedes and Iveco and Shell and others. So yeah, this is a good point. We don't, in visibility terms, you just don't see as much going on in the UK. So therefore you think, oh, it came in, it went. No, it's still there. It's still going strong. It has slowed down, but it's we're well positioned to see where all these new big investments are going to be.
There's a question here about Alcogen and its investment plans. Can you sort of tell us a bit more about that, please?
Yeah, Alcogen is one of our investments. They have facilities in Estonia and Finland. They make a fuel cell, which is the reverse of an electrolyzer, although the solid oxide fuel cell that they make, solid oxide is just, if you think about a fuel cell, it's basically anode, cathode, electrolyte, and it's about the materials that you use to make that. So they with solid oxide, the electrolyte is not a liquid; it's a solid. It's very much more efficient. It gets much hotter. The interesting thing about fuel cells that are made with solid oxide is you can reverse them and turn them into electrolyzers. Anyway, so that's what Alcogen do. They have got supply contracts to companies across Europe, which now require the need for scaling up the manufacture, which is why we invested. And so they're building a factory in Estonia to start doing that. And like all companies, they're attracting the funding to do that. When people read the headlines and think this is a non-starter, this sector is difficult. But the existing investors, us included, have been supporting that, and we've been updating the market on how funding's been going into Alcogen. And it's quite I mean, Alcogen is a good example of getting access to grants that are available, and Alcogen's been doing that.
Great. Okay. Thank you. Could you talk a bit about Strohm, please? It does seem, obviously this has been a successful company, but it does feel like it's been all in the oil and gas business rather than the hydrogen business. Am I being? You're not
wrong about that. Yeah, I mean, we invest into Strohm with some targets for them to transition from the oil. And what they do is they make a pipe. It's a thermal TCP pipe, which is very, very dense and very, very light, but can be wound onto these huge carousels. So you never have to join the pipes together when you're under the sea. And so there's great applications for this offshore in the oil and gas sector. It has with the hydrogen sector slowing down. Yeah, that has been a factor. And so we're having to sort of like lengthen the targets that Strohm works to get to that point. We had previously talked about offshore hydrogen, which is basically on your offshore turbine. You put an electrolyzer at the base of the turbine. So instead of generating electricity to shore, where there's lots of losses when you put it through the cables, you're putting hydrogen through a pipe, and there are no losses at all. It's a lot more efficient. That sector was being developed by Ørsted and another of the number of sort of northern European companies that have slowed down, but they haven't stopped. So yeah, it's still going ahead, but we're having to sort of give them a longer length of rope to get to that point of the transition.
If I had to sort of summarize it, this sort of message I'm getting is it's all going ahead, but patience is the watchword, really. Is that
yes.
fair? Yeah,
absolutely. And unfortunately, a lot of retail investors were sold hydrogen back in 2021 as a mega trend, which is going to convert and change and take over the world. It was never set out to be that. It's a very smart technology that is being used now, and that's what we're investing into. So but it has taken a bit longer. But it's, patience is required. But it's not stopped. It's going ahead, but it's just it's not in the headlines as much.
That's brilliant. Thank you very much for that, Richard. Well, we will be patient. We will have you back in a year or so and see how things have gone. Hopefully, the share price will be a lot higher.
I mean, it's an absolute steal at this level if you see it the way we do in terms of the confidence in the sector. And and we'll have done something with Cordiant by then, and I'd be happy to come back and talk about that.
Brilliant. Thank you very much indeed. Okay.
Thank you, James.
We will be back next week. Andrew Bahati will be here talking about what happened over the course of February. And our guest in terms of the managers is going to be Phil Kent from GCP Infrastructure, which has actually been performing a bit better recently, which I'm quite pleased about as a shareholder. So thank you very much for your time today, and we will see you next week. Have a good weekend.